my name is Alex Curlich with GustinShow.com. Breaking news, record low mortgage rates that you hear on the news are no longer there because they are actually skyrocketing because of liquidity issues and because of staffing issues. So let me explain that. So let's say you have $100 and you lend everybody, let's say you lend 8 people $10 every month and they pay back that same month. So you let $90 out and you get your $90 back. Imagine if there's demand of $1,000 that all the people who wanted to borrow $10 from you are now borrowing $50 each, and you got 10. Now you got to lend $1,000 out and you don't have $1,000 because you only have $100 to lend. And you gotta get your money back from everybody else before you can re-lend again. That's what's happening to banks. They're at capacity. It's called liquidity issue. So if you hear someone say there's a liquidity issue, that's kind of one aspect of liquidity for you guys to understand. So right now there's been too many locks and not enough money to support those locks. Then you got the same factor with the stock market crashing. A lot of these investors hedging it in a really weird way. They got run over, so they lost money on these hedges. So it's kind of hard to explain this, but there's a mortgage-backed security in a 10-year treasury, and sometimes these people try to make a little bit more on these locks, and they'll hedge in the 10-year and then unwind it into the mortgage-backs later. Well, that spread went like that, and they all got crushed. So there's another liquidity issue there. Now, when it comes to staffing issue, again, when you normally have enough people to process $9, $10 loans to your friends, and you and your girlfriend are processing your $10, now you get 1,000 loans of $10 a piece. You guys can't process enough, so what they do is they raise the rate so nobody wants to borrow at all. So if you charge them double, if you lend $10 and they pay you back $20 next week, people say, I'm not going to borrow $10 with a 100% rate. So what they do is they raise the rates up until they can catch up processing these loans, and then they lower them back down. So what I'm seeing the last few weeks is they lower them down, and then there's a bunch of locks there ready to lock because there's so much demand for rates on the low side, not where they're at on the high side, but when they dip down. So every day there's like a dip down, everybody locks, they go back up. The next day they're up, nobody locks. They catch up. A couple days later, they lower the rates, everybody locks, they go back up. So that churning process has to happen a lot until all this demand gets taken out and the staffing gets staffed to absorb all these loans, and we get through them all. So as that happens over time, I think we're going to see rates head lower, as long as everything else stays good with this coronavirus and the economy. So keep an eye out for your rate. If the loan officer you're working with says here's the rate, it's here today, you gotta jump on it right away. You got about an hour before their price change and jack it back up. So if you have a specific rate you're looking for, be ready to pounce on it in quick time, otherwise you're going to lose it. If you want to wait 30, 40, 60 days, you may get even a lower rate than the one you're trying to get now, because where the indices are priced today, rates should be in the 2s, and they're not because of this demand and staffing and liquidity issue that's going to get worked out, because the Fed is pumping money into liquidity to give these banks bigger lines to borrow off of for short-term lending. So that's breaking news from GustinShow.com. Thank you very much. 630-915-7550.